Howdy, Jacob here. Today we're looking at Teradyne in the semiconductor and semiconductor equipment industry. 16.6 billion market cap on 15.8 billion enterprise value. Pretty frothy PE as it looks right now at 37. Return on invested capital does look very good though at 17.4% the last year, averaging in the last couple years, probably mid 20s, which is pretty substantial. Growth is pretty volatile if you ask me. We see 1.6 billion in 2014, up pretty good to 2.7 billion in 23, but down double digit over year the last 2 years after growing very substantially from 2019 to 2021. So we're seeing a little pullback there. Dividends have grown pretty substantially, earnings per share much greater, so that's positive, less payout for their dividends. Their balance sheet shows about 820 million cash-like products through cash and equivalents and short-term investments, with only 961 million in total liabilities, zero long-term debt, zero short-term debt. So that's very positive. Their only interest-bearing debt appears to be their capital leases. So definitely no concern from the balance sheet perspective with that much cash, no short-term or long-term debt, and that much liabilities. We're looking very positive here from just no valuation standpoint, but just from a business standpoint. Capital expenditures are actually roughly the same from 10 years ago, with cash from operations a little bit higher, so we are seeing a little bit more free cash flow. But to me, based on the fact that I saw return on invested capital as high as mid 20s, low 20%, I'd want this company to be reinvesting much more back into themselves, and we are not seeing that. You can see companies reinvest back into themselves pretty substantially by looking at one, the investment line. It sometimes has your hard assets and or goodwill or intangible assets, but really the capital expenditures line is going to show you that as well. You're going to get the innate increase of property and plant due to inflation and costs going up, but the more you reinvest back in your business, the more you're going to see that line increase, which we can see probably most substantially through Amazon, where their profits have actually, they're positive now, but it's been tough to get margins due to the fact that they're just reinvesting almost everything they have back into the business to get that extra growth, which is, a fantastic way to grow a company for sure. But we see here that they're actually pretty flat, so not a whole lot of reinvestment. Use of cash is very heavy on the share repurchases, probably 50 to 60% plus, probably greater than that. Probably 60 to 70% of their free cash flow is going towards share repurchases. A little bit through their dividend. That dividend is paying out maybe 15 to 20% of their 5-year average free cash flow. It's very low. There's no concern there. And they paid down a little bit of debt, but again, they're out of long-term and short-term debt, so they can really focus on reinvesting back in themselves. Hopefully, as their historical rate of return on investment has been low 20%, which is very impressive. So let's start with making some assumptions here. I think we're ready for that. I think we're going to see pretty volatile revenue growth, but I think I would not be surprised if it grew at an average of 5% a year. I think a 16p price free cash flow on the fact that semiconductor industry, equipment industry is just has a lot of players in it, and I don't think Teradyne necessarily has the moat. Has that moat to really incur a higher P and price to free cash flow. And also they're kind of inconsistent, and people who own stocks like consistency. They like patterns that, are, I guess I'm just saying consistent again, but they just like consistency, and we're just not seeing that there. It's a very volatile business. And so roughly I'll go with these averages. Let's do 22, 19. If they buy back 1% of shares, that would cost them about 160 million, 170 million. Okay, let's do 2% of shares. So what I did there is I just looked at the market cap currently for an approximation of what 1% share buybacks would cost them. And it would, at a 16 billion valuation, it'd be about 160 million. So 320 million or 330 million roughly is going to be 2% share buybacks. They can afford that through the 5-year average free cash flow and what they've seen historically. And then that would leave still a bit of room for reinvestment and dividends. So the dividend, let's grow that with their revenue growth. So their payout's still pretty small. This is leaving probably 25% of free cash flow to reinvest back in themselves, which should still leave a good amount of money. I still think they can find opportunities to reinvest with that type of money to get that type of return. And so right now, I'm just saying it looks a little bit expensive. I think maybe I'm being conservative here on the revenue side, but I think that it's just a volatile business, and I'm just took an average roughly of what I think the business is going to do year over year for the next 7 years. And then again, 16p, I think that's a little bit higher than what the market would. The market's average has been historically, but I think that they don't. I don't know if they deserve that much of a premium due to the fact that what will growth be in 7 years? What will the moat be? I don't know if it'll be that much better than just a market average company. And then still looking at a 50% return. So right now, just a little bit frothy, my perspective. And I hope you enjoyed the video. Have a great rest of your day. Thank you.